Hello, this is Japanese Economic Review Channel. Today, we decode the significant upward revision in Japan's Q4 2025 GDP. We'll explore the structural drivers and methodological shifts from the first to the second preliminary estimates, revealing a clearer picture of Japan's economic reality. Let's start with the headline. The annualized real growth rate for Q4 2025 jumped from plus 0.2% in the first estimate to plus 1.3% in the second. This is a significant upward shift driven almost entirely by structural upgrades to private demand data inputs. What drove this leap? The primary catalyst was private non-residential investment. Its contribution to GDP growth spiked from 0.0 to plus 0.3 points. Conversely, private inventories acted as a secondary drag, widening from minus 0.2 to minus 0.3 points. Understanding this requires looking at the estimation pipeline. The first estimate prioritizes speed, relying on supply-side proxies and ARIMA models. The second estimate prioritizes accuracy, integrating demand-side hard accounting data from the Ministry of Finance. This matrix details the shift. Private investment moves to a fusion with demand-side financial statements. Inventories shift from algorithmic models to physical accounting data. Finally, missing third-month data is replaced with finalized retroactive statistics. Let's deep dive into capital expenditure. The first estimate captured only production and shipment volumes. The second introduces rigorous corporate financial statements. This integration captures true capital expenditure that supply-side proxies initially missed. The discrepancy was massive. The supply-side nominal quarter-over-quarter growth was 6.2%. However, the newly added demand-side MOF data showed a 10.7% growth. This 4.5 percentage point delta is the primary engine behind the Q4 upward revision. Next, private inventories. Initially, raw materials and work in progress were estimated using ARIMA models. In the second estimate, these proxy models are discarded in favor of hard data from MOF corporate statistics, eliminating algorithmic blind spots. Replacing models with accounting data revealed deeper inventory drawdowns. The total Q4 real change in private inventories equaled a drag of minus 1,027 billion yen, primarily driven by wholesale and retail sectors. The third factor is the missing month. The first estimate extrapolates December's data. By the second estimate, finalized source data, such as updated balance of payment statistics, become available, replacing extrapolations and tightening the margin of error. Updating these core data points triggers a ripple effect. Introducing new original series data forces a recalculation of X12 ARIMA seasonal adjustments, retroactively revising historical data back to Q1 1994, using COVID-19 anomaly dummy variables for stability. In conclusion, the first estimate is a fast-acting proxy, but the second reveals the structural reality, 1.3% true growth. This revision proves corporate capital expenditure was highly resilient, providing a much stronger foundation for policy and investment modeling. Thank you for watching the Old Japanese Fairy Tales channel. We look forward to having you with us again.